In the last 48 hours, $150 an ounce has been completely wiped off the price of gold.
It's staggering.
It really is. It plunged straight down to the $4,050 level. And, I mean, it's leaving a lot of seasoned investors just staring at their screens in absolute disbelief.
Well, I mean, that is the defining feature of what we call a trapdoor market. People expect the vault to hold, and when it suddenly just doesn't, the psychological shock it's almost as impactful as the actual financial loss.
Oh, absolutely. Welcome to today's deep dive. Whether you're, actively managing a portfolio right now, or you're just intensely curious about the hidden levers that move the global economy, we have a very clear mission today.
We've got a lot of ground to cover.
We do. We are going to unpack this staggering June 24th market snapshot for gold and silver. We're breaking down the hidden mechanics causing this really overwhelming sell-off.
Yeah, and analyzing those critical technical support levels that basically the entire financial world is sweating over right now.
Right, and exploring the psychological strategies that analysts are urging people to adopt.
Because the psychology is arguably the most critical component here. I mean, when an asset drops $150 that quickly, human emotion often just completely overrides mathematical logic.
It totally does. But before we can really understand the why, we kind of need to survey the anatomy of the drop itself, right? Let's look at the actual damage.
Yeah, let's get into the numbers.
So gold is currently hovering in this incredibly precarious zone, trading somewhere between $4,050 and $4,070 per ounce.
It's a very tight window.
It is, and it's fighting desperately to hold on to a major support level. But looking closely at the data we have, there is absolutely no confirmed bottom yet.
None at all. The market is effectively holding its breath. Usually when you see an asset take a precipitous fall like that, you expect a reflexive bounce.
Like a dead cat bounce or just people rushing in?
Yeah, like a sudden gasp for air, right?
Yeah.
Buyers rushing in to grab a discount. But we are seeing a very, very fragile stabilization around 4,070, and it completely lacks conviction.
Meaning no one's really committing.
Exactly. The sellers are entirely driving this narrative, and the buyers are, well, they're terrified to step in front of that kind of momentum.
It's like catching a falling knife. And if gold is struggling for air, silver is, it's flashing a blinding red warning sign.
Oh, silver is definitely the canary in the coal mine here.
Mm-hmm. Right, because it actually initiated its drop earlier than gold. We're looking at this unprecedented correction of about $5.80 per ounce.
Which is massive for silver.
It's dragging the price all the way down to around $61.10. Now, I want to really understand the relationship between the two here. Silver is kind of like the sports car of precious metals, right?
That's a good way to look at it.
It has a lighter chassis, so when the economic road gets bumpy, you feel the suspension rattle a lot faster than you do in, say, the heavy armored truck of gold.
I like that analogy.
Thanks. But here's my question for you. Is that sports car actively dragging the armored truck off the cliff, or are they both just reacting to a collapsing bridge underneath them?
That's the key question. They are definitely both reacting to the collapsing bridge. But your sports car analogy is really spot on for how we should interpret the data.
How so?
Well, silver occupies a very unique dual role in the global economy. I mean, it's a precious metal, obviously, meaning it functions as a store of value. But it's also a highly utilized industrial metal.
Oh, right, like for electronics and stuff?
Exactly. Electronics, solar panels, massive scale manufacturing. So because of that industrial component, silver is far more sensitive to shifts in global economic demand.
Ah, I see.
Yeah, so when institutional investors foresee an economic slowdown, they dump silver much, much faster than gold.
Which totally explains the earlier and sharper drop we saw.
Right. And analysts are interpreting silver's breakneck decline as a reflection of this really intense defensive psychology that's just washing over the broader market right now.
And if silver loses that $61 support level, what happens?
If it loses 61, the downside risk just opens up significantly. That level isn't just a random number, It represents a real threshold of confidence.
So breaking it is a big deal.
A huge deal. Losing it signals that capital isn't just taking casual profits. It is actively fleeing the entire precious metals sector.
Wow. Okay, so if capital is fleeing the safety of the vault, we have to ask where it's running to, right? Because the money doesn't just disappear, it relocates.
Always. Capital always finds a new home.
Right. And that brings us to the macroeconomic bulldozers that are currently pushing these metal prices off the cliff. And the undisputed heavyweight champion in the market right now is the U.S. dollar.
Oh, absolutely. The dollar is dictating the terms of engagement across every single asset class globally right now.
So let's look at the US dollar index, the DXY, which for you listening is essentially a metric that measures the muscle of the US dollar against a basket of other major world currencies.
Right. Euros, yen, pounds, that sort of thing.
Exactly. And the DXY has just hit a 13-month high. It is sitting at approximately 101.6. Capital is very clearly prioritizing the dollar as the ultimate defensive shelter.
Yeah, and you really have to look at what's backing up that dollar strength. It's the Treasury yields.
The 10-year U.S. Treasury yield is hovering near 4.5% right now.
Which is incredibly high for recent history.
Right. The broader market is aggressively pricing in a hawkish Federal Reserve, meaning the Fed is prioritizing fighting inflation by keeping interest rates aggressively high.
Yeah, and the data is pretty stark. It shows a 36% probability of a rate hike in July and over a 70% chance for September.
So they're not backing down.
No, not at all. And to understand why this creates a bulldozer effect, you really have to look through the lens of institutional money managers.
Like pension funds and sovereign wealth funds.
Exactly. Pension funds, major banks, they do not operate on sentiment or tradition. They don't care about the romance of gold. They operate on a strict mathematical calculus of yield versus risk.
Wait, okay. If you're listening to this and, you're looking at your own grocery bills, you're probably screaming at the audio right now.
I wouldn't blame them.
Right. Because if inflation is still so hot and stubborn that the Federal Reserve has to remain this hawkish, shouldn't gold, like the historical undisputed champion of inflation hedging, shouldn't it be skyrocketing?
That's a great question.
Why on earth are investors dumping the ultimate inflation hedge to run into the arms of the dollar?
This is perhaps the most common paradox that frustrates everyday investors. And the answer really boils down to the mechanics of opportunity cost.
Opportunity cost. Okay, break that down for us.
Sure. Think of holding gold like owning a really beautiful, completely barren piece of land. It might hold its value over time. It might even appreciate significantly over a decade. But month to month, it doesn't pay you rent.
It just sits there.
Exactly. Gold yields absolutely 0%. Now imagine the plot of land right next door is a U.S. Treasury bond.
Okay.
Because the Federal Reserve is keeping rates elevated to fight that stubborn inflation, that 10-year Treasury bond is suddenly offering you a virtually risk-free yield of almost 4.5% every single year.
So if you're managing a $100 billion fund, you're staring at gold, which pays you nothing to just hold it.
Right.
And then you look at a U.S. government-backed bond that pays you a guaranteed 4.5%.
Precisely. I mean, when the dollar is flexing at a 13-month high and yields are this attractive, the opportunity cost of holding a non-yielding asset like gold simply becomes too mathematically painful.
Too painful for institutional money to justify.
Exactly. They calculate that the guaranteed 4.5% return from the bond outpaces the potential protective upside of gold in the short term.
Wow. So they aren't ignoring inflation at all.
No, not at all. They're simply rotating into the asset that actively pays them a premium while they wait for inflation to cool down.
That makes so much sense when you frame it like that. But this isn't just the story about domestic interest rates, is it? Our sources highlight this really fascinating geopolitical twist that is basically pouring gasoline on the dollar's strength.
Oh, the Iran situation. Yeah, this is huge.
Right. There have been recent developments in the U.S.-Iran negotiations. Specifically, Iran is being permitted to export oil on the global market.
Which, on the surface, introducing more energy supplies sounds like a move that would ease global economic tensions.
You would think so. More oil usually means lower prices, less stress. But there is a structural catch here.
A very intentional catch. The payment settlement mechanism.
The oil must be paid for entirely in U.S. dollars.
Yeah, and this is a textbook real-world demonstration of the petrodollar dynamic.
How does that work in practice?
Well, by mandating that these new, really large-scale oil transactions be settled exclusively in U.S. dollars, you artificially engineer an immediate surge in global demand for the currency.
Because everyone needs dollars to buy the oil.
Exactly. Every nation or entity that wants to purchase that Iranian oil, they can't use their local currency. They must go into the foreign exchange market and buy U.S. dollars first.
Which means the dollar's value just gets pushed even higher.
Right.
And because gold is priced in U.S. dollars on the global stage, a stronger dollar acts like a direct wrecking ball to the price of gold.
It's an inverse relationship, yeah.
It makes the metal instantly more expensive and, just less attractive for any buyer who's holding euros, yen, or rupees.
It prices them out of the market.
So, a diplomatic handshake in the Middle East over energy exports directly contributes to a $150 drop in a retirement portfolio holding gold here.
It's kind of wild to think about. But the interconnectedness of modern finance is just absolute. A localized policy shift almost always has a global ripple effect.
Well, when the dollar acts like a wrecking ball globally, it fundamentally alters the behavior of international buyers, too.
Yeah.
And that is exactly what we are seeing happen in the East right now.
Yeah, the dynamic in Asia is completely shifting.
It's not just Western economic policy pushing these prices down. There's the structural shift occurring in Eastern investment behavior, and it is compounding the downward pressure just as gold approaches a terrifying threshold.
Right, because for a very long time, Asian demand has essentially functioned as the reliable safety net for the global gold market.
Historically, when Western investors sell, Eastern buyers step in and buy the dip, right?
Exactly. It's been a very predictable seesaw.
Well, that net appears to be tearing wide open. The World Gold Council is reporting that Asian gold ETFs, exchange-traded funds, are seeing their first capital outflows since August 2025.
First time in a while.
And the volume is just staggering. A total of $1.2 billion has been liquidated, primarily from China.
1.2 billion. Let that sink in.
And India, another historically, insatiable gold consumer, has also pulled about $61 million.
Yeah.
I really want to understand the mechanism here. Why is the East, a region famous for buying the dip, suddenly abandoning that strategy?
Well, we really have to differentiate between cultural retail buying and institutional ETF behavior.
Okay, what's the difference?
So a retail buyer in India or China might see a price drop and think, great, I'll buy physical jewelry or coins as a cultural store of wealth.
Right, individuals taking advantage of lower prices.
Exactly. But ETFs are managed by institutional entities, and these managers are governed by strict risk models and very rigid liquidity requirements.
They aren't buying jewelry.
No. When their local currencies weaken significantly against that surging US dollar we just talked about, it creates immense domestic financial pressure for them.
Ah, so they need cash.
Right. Institutional managers are often forced to liquidate their gold holdings, either to cover margin calls elsewhere in their portfolios or just to shift capital into better yielding domestic assets.
So an outflow from an ETF isn't just numbers moving around on a screen. It means the fund is actively selling the physical gold it holds.
Exactly.
Which is adding raw supply to a market that already lacks buyers.
It shatters the short-term demand narrative completely. I mean, it removes the floor exactly when the market needs it the most.
And when you completely remove that Asian safety net that normally catches these price drops, the pressure on the next technical safety mechanism becomes just enormous.
And we know exactly where that mechanism is sitting.
Right. Right now, it's sitting exactly at the $4,000 mark. Saxo Bank has issued a major warning regarding this, pointing to the 4,000 to 4,100 range as an incredibly sensitive support zone.
And we're at 4,050 right now.
Way too close for comfort. And towering over that 4,000 threshold is the impending PCE data release.
Ah, yes, the Personal Consumption Expenditures Index.
Can you explain why this specific report matters so much?
Sure. It is basically the specific inflation yardstick that the Federal Reserve trusts the most.
More than the CPI.
Yeah, because it traps what consumers are actually spending out in the real economy. It adjusts for behavioral changes when prices rise. If beef gets too expensive and people switch to chicken, the PCE accounts for that substitution.
Got it. And the entire global financial apparatus is basically paralyzed, just waiting for this single metric to drop.
They are. Nobody wants to make a move until they see those numbers.
So if the PCE data comes in hot, indicating that inflation is still stubbornly high and that 4,000 threshold breaks, are we looking at a technical free fall? Or is the long-term historical uptrend of gold still somehow intact?
Well, to understand what happens at 4,000, we really have to look at how modern markets actually operate. We aren't dealing with human traders shouting on a floor in Chicago anymore.
Right, it's all computers.
Exactly. We're dealing with server farms.
Yeah.
And to an algorithm, $4,000 isn't some psychological barrier. It is a binary trigger completely devoid of human emotion.
It's just lines of code.
Right. These algorithms are programmed with very strict if-then parameters. If the price drops below 4,000, then execute a massive block of sell orders.
Boom, instant sell-off.
Yeah. If that level breaks, You trigger a cascade of machine-driven selling that creates really sharp, immediate downside violence.
The machines essentially just feed on each other's momentum.
Exactly. It becomes a self-fulfilling prophecy in the short term. Now, to your question about the long-term trend, analysts do emphasize that the multi-year upward trajectory isn't fundamentally broken.
Okay, that's a relief for some people.
Yeah, the structural arguments for owning gold, such as unprecedented sovereign debt levels and the eventual debasement of fiat currencies, those remain completely valid.
The big picture stuff hasn't changed.
Right. But the short-term momentum has been severely wounded. I mean, with the Asian ETF's safety net pulled away and that algorithmic cliff looming at 4,000, the floor is dangerously fragile right now.
Which brings us to the ultimate question for the actual investor listening to this. When you are looking at this $150 haircut and wondering how to navigate June 24th, you need a coherent strategy.
You definitely need a plan. You can't just react.
Exactly. With all these macroeconomic forces arrayed against gold and that 4,000 line under siege, how do you proceed? According to our sources, the analytical community is split into two very distinct schools of thought regarding the current 4,050 level.
And both of these approaches rely on a specific interpretation of the current risk environment.
Okay, let's examine the first group. We can call them the disciplined waiters.
Good name for them.
Their strategy is highly defensive. Basically, hold your cash and actively wait to see if prices drop below 4,000.
Right.
Their logic is built on everything we just broke down, right? The commanding strength of the dollar, the highly attractive 4.5% treasury yields, and the looming uncertainty of the PCE data.
They calculate that there's absolutely no mathematical rush to deploy capital when the macroeconomic weather is this hostile. Why step out into a hurricane?
Exactly. But then you have the second camp, which approaches the problem from a philosophy of probability.
The gradual scale.
The gradual scalers. Their strategy is to buy small fractional portions of gold right now at 4,050 rather than waiting.
Right.
But honestly, I have to push back on this approach. If all the macroeconomic data, the surging dollar, the high yields, the institutional outflows from Asia, the algorithmic threat at 4,000, if every single indicator points downward, aren't the scalers just willingly throwing quarters into a wood chipper?
It definitely looks that way on the surface.
Isn't that just a psychological coping mechanism to feel like they're doing something?
It sounds totally counterintuitive, I grant you that. But it is actually a deeply calculated risk management technique.
How so?
Well, the gradual scalers operate on one fundamental truth of investing.
Yeah.
Nobody rings a bell at the absolute bottom of a market.
Right. No one knows for sure.
It is statistically impossible to consistently predict the exact dollar amount where an asset will reverse course. By deploying a really small fraction of capital at 4,050, they establish a foothold.
Okay.
If the price drops further to, say, 3,900, they still have the cash reserves ready to buy another small fraction, which mathematically lowers their overall average entry cost.
So they are prioritizing the process of capital allocation over the fantasy of perfect timing.
That is the core philosophy, yes.
Yeah.
They don't mind a little short-term pain if it gets them a blended entry price they like over the long haul.
Interesting. What both of these camps agree on, however, is the supreme danger of emotional extremes in a trapdoor market like this one.
Oh, without a doubt. The most destructive mindset an investor can adopt right now is the fallacy of perpetual motion.
Meaning?
The belief that because an asset is dropping violently today, it is somehow destined to drop to zero tomorrow.
Right. Or the opposite extreme, which might actually be worse, the pure fear of missing out. FOMO.
FOMO is a portfolio killer.
It is that desperate urge to take every dollar of cash you have and go all in right now because you've convinced yourself that 4,050 is the absolute bottom, and if you don't buy immediately, you're going to miss the rebound.
Yeah, attempting to catch a plummeting asset with your entire portfolio usually just results in severe financial bleeding.
So true.
The true lesson embedded in the June 24th data isn't really about perfectly charting the future price of gold. It is a masterclass in managing your own psychological impulses when the market abruptly pulls the rug out from under your thesis.
That's such a great point. The truest test of an investor doesn't happen when a chart is trending up and every position is green.
No, anyone can make money in a bull market.
Right. Building wealth in a straight-line bull market requires very little skill. The real test is a day like today. Do you possess the discipline to adhere to a tiered, unemotional capital strategy when the floor feels like it is giving way?
That's the million-dollar question.
The mantra from the analyst is clear. Do not chase the minor rebounds. We saw a tiny technical bounce to 4,070 earlier, and, it is incredibly tempting to just sigh in relief and assume the worst is over.
It is, but you have to resist that.
Mm.
In reality, without structural confirmation, it's likely just a brief pause before the next leg down.
Just a breather.
Exactly. You must wait for the underlying macroeconomic data like that PCE release or a real shift in treasury yields to confirm a change in direction. Emotional reflexes will only burn your capital.
Well, to pull all of these really intricate threads together for you listening, the June 24th market snapshot is the literal definition of a perfect storm.
It really is.
We have a staggering $150 vaporization of gold in just 48 hours. We have the US dollar asserting total dominance at a 13-month high. We have 10-year Treasury yields sitting at a highly attractive 4.5%, which is actively draining institutional capital away from non-yielding metals through the sheer math of opportunity cost.
Yeah, and we also have a historic structural shift in Eastern momentum. With $1.2 billion flowing out of Asian ETFs, entirely removing the market's traditional safety net.
And wrapping around all of this is an entire global financial system holding its collective breath, right? Waiting for the PCE inflation data to hit the wires, all while staring down an incredibly fragile, machine-driven $4,000 threshold.
It is a phenomenal amount of complex data to process. But, I want to leave you with a final thought to mull over, specifically regarding that U.S.-Iran oil development we analyzed earlier.
Yeah, let's just hear it.
Just consider the absolute irony of modern global geopolitics. Diplomats sit in a secure room and painstakingly agree to a measure designed to ease international pressure.
Right, allowing Iranian oil exports to flow into the global market.
Exactly. It's intended to be a stabilizing, productive handshake. But because of the deeply entrenched mechanics of the global financial system, which mandates that those new energy transactions be settled in U.S. dollars, that single stabilizing handshake engineers an overwhelming surge in dollar demand.
Wow.
And that dollar strength then ripples outward, indirectly crushing the wealth stored in precious metal portfolios in completely unrelated parts of the world.
It's crazy.
It perfectly illustrates our hyper-connected reality. A diplomatic signature intended to solve a problem in one hemisphere can effortlessly trigger a severe sell-off in your personal safe haven vault the very next morning.
It just shows you the heavy iron door of the vault was never breached. The foundation of the building itself shifted.
That's exactly right.
Well, thank you so much for joining us on this deep dive. Keep questioning the hidden mechanisms behind the daily headlines. Remain strictly disciplined with your capital strategies, and we will catch you next time.